Banking with Us is brought to you by Flight Connections. Now, private equity is an alternative investment class and consists of capital that is not listed on a public exchange. Now, today we stop by Delta Capital Partners to learn more. I'm Amita Prasad-Webb, and this is Banking with Us. Delta Capital Partners is built to focus on bespoke private equity deals and strive to deepen wealth-driven relationships across the region with the utmost integrity. Zachary Harding is the executive chairman.
I joined as Group Chief Executive Officer of Stocks and Securities Limited last year. One of the things that we realized is that the brokerage business itself is very marginalized. So it's fee-based, commission-based, and within reason, unless you're doing very large IPOs or high volumes of trading, you're always just going to be getting small commission checks. So we wanted to be involved in the higher value end of wealth creation on the business side. There was a venture capital entity before, but that focused on small entities only, and we wanted to focus on larger entities. So the boards met and agreed to form Delta Capital Partners, which would become the Caribbean's true private equity firm, focusing on medium-sized businesses and really making investments in real sector companies that had the potential to grow and scale, not just in Jamaica, but across the Caribbean. So Delta Capital Partners itself was formed primarily by two individuals, Hugh Croskery, who's the founder and chairman of Stocks and Securities Limited, and myself, who formerly had a private equity firm called Hyperion Equity. I had quite a substantial amount of deal flow, but Stocks and Securities Limited is a well-known, well-recognized institution in the financial services space. So we basically combined the benefits of both entities for me to bring the deal flow to the table, but then also leverage SSL's assets to create a new type of entity that can really support the growth in high-value businesses. Delta Capital looks for solid companies that we know we have the expertise and capabilities to help them to grow significantly. So usually when investing, sometimes people just invest in stocks or bonds. And if it's a bond and there's a specific coupon, a specific interest rate, you know exactly what you're getting. In the case of stocks, very often people, quote unquote, play the stock market, where they take chances on companies that they like or they think they have the potential to make some returns from. But essentially, they don't really have a way of participating. They're hoping that the company will continue to perform well and give them some sort of a return. In the private equity space, what we look for is companies that we are very active in. So we're not passive investors at all. We won't invest in a business unless we can get in the business with the existing shareholders and partners and really add value. If there's no value for us to add, we'll pass on that company. So what we've done is we've created a team, a diverse team of experts that have worked across multiple sectors. And now we're able to bring our experience and expertise to the table and combined create new value that wouldn't have previously existed in the company that we're investing in. So we put the capital to work, but then we also put the intellectual capacity behind it to help to create real rewards. These offerings are important because people are always looking for ways to create wealth and to create value. So they have existing resources, usually cash, and they want to place it somewhere where they can use that cash to help to grow a business and make a return. We provide businesses and opportunities to invest in businesses that are off market. So very often you'll hear me use the phrase bespoke or customized offerings, and that is because you're not going to find them anywhere else. We're not a broker of investment opportunities in the private equity space. We don't have people coming to us to place money and then we just take a fee for placing the money. We are essentially taking investment into Delta, where people feel confident with our abilities to invest their money in businesses, and then we are getting active in the business. So it's new ways of creating value that people would not have normally had access to. The equity ecosystem model is one where people place cash in a company, but they put it at risk for an ownership stake. So it's different than the debt model or the credit model, where people are just lending money and just making an interest rate only on it. In many instances in the private equity space, these investments are unsecured. You have to actually believe in the business, know the management team that is in place, look at the macroeconomic environment, look at the political stability within our country, and be able to assess what is the potential for this business to grow. So money is put in, the businesses take that money in as equity, they then put that money to work and then grow the valuation of the company. At the end of the day, you're trying to get a company to increase its value, not just pay an interest rate. So many times the Caribbean has been overlooked as an investment destination. Typically, even within the Caribbean, we see ourselves as some islands, developing countries, third world countries, whatever name you want to ascribe to it. But when you look at the Caribbean as a region, there are many benefits to investing in the Caribbean. So let's look at a few of them. One is proximity to developed markets, including North America, USA, Canada, Mexico, etc. Hour and a half away, maybe by plane ride. So it's not like you have to fly way around the world, a 12-hour flight to get somewhere. One. Two, largely English speaking, meaning that even the countries that English may not be the dominant language, they still speak English there. So you can still go to Damrep and conduct business in English, or go to Haiti and conduct business in English. Third thing I would say is scale. When you look at the English-speaking Caribbean on its own, you add up, the Barbados, Trinidad, Jamaica, etc., and some of the smaller islands, you're talking about somewhere around maybe 8 million people, right? That's not an insignificant market. You add, let's say, Puerto Rico to that, you're at about 12 million people, you're now the size of Singapore. Let's say you add Haiti to that, at the 22 to 24 million people range, you have more people than Australia. You add Dominican Republic to that, you're at about 34 million people. That's bigger than the size of Canada in terms of population. And if you add Cuba, you're at about 44 million people. That's the size of Spain. So we're not an insignificant market.
Anthony Dunn is the CIO, Chief Investment Officer of Delta Capital Partners, as well as COO of SSL Venture Capital Limited. Anthony joined the SSL Group in 2009 after founding the Ostrich Private Equity Fund.
In its simplest form, private equity is investing in private companies, and what it involves is it's an alternative asset class, meaning that you pool investors' money and invest in private companies with the aim that you help them to grow and expand, and then you exit by selling that stake in the future, typically between 5 to 10 years.
And how is it different from public funding?
It's different from several perspectives. One, liquidity. In a public space, the market determines pricing, and so you can buy and sell the shares any time of day once the stock market is open. You can also raise money through the stock market from a myriad of investors. In private equity, you tend to more target very high net worth investors and institutional investors. And it's not so liquid, meaning that you can't get in and out of that stock or that company you've bought a share into as easily as you would in a public market. So private equity is for persons who understand the nature of long-term investments and has patient capital. And even from a pricing perspective of the shares, that's never normally determined like the public market, which has a reference share price every day that you can, based on the trading activities for that day. Typically, in private equity, you can, between 5 to 10 years is the normal horizon that investors look to invest for. There may be opportunities where you invest today and in a year's time you can exit the investment because another better opportunity has come up or an opportunity has arisen for you to sell your shares at a multiple than what you initially invested for. But typically, and the standard is between 5 and 10 years in terms of the horizon.
And what types of private equity firms are there?
You start typically with the venture capital fund, which typically invest in startups and or ideas of persons who have vision about a particular product or service that they want to introduce to the market. Then you have those funds that are leverage buyout funds, meaning that they invest in a mature company, leveraging the balance sheet, using that same company's assets to acquire it, and then looking to unlock the value down the road. And then you have the true private equity firms, which are growth private equity, which invest in companies that are looking capital to grow and expand a product or service, and then looking to exit that investment down the road when you have multiplied the value.
How does private equity benefit our economy?
You can consider it to be like the engine of the economy. It's about commerce and trade and economics, right? So there are people with cash and there are people who need cash, and you're bringing them together. There are people with certain skill sets and competences that can help move someone who is in a company and wants to grow that company but doesn't possess those skill sets and stuff. So it's a whole ecosystem, so to speak, when it comes on to private equity. And most entities in any economy, private equity is the main driver behind the scenes in terms of private investors owning the businesses that is creating that employment growth, creating that tax contribution growth, creating economic activity. So most private companies are funded or owned by private equity in the background until they become public down the road. Companies that are looking to expand and grow, so scale up to another level in terms of their growth, those are most suited. So it would be companies that has been operating at minimum, ideally, 3 years, would have gone through that process of the learning curve and now looking to grow and take their solution or product to some further level. Companies where the owners are looking to retire. So you have a lot of private companies where, whether they're owned by a group of families and you have a patriarch in the family who wants to retire but there's no succession planning. Those are also some good companies for private equity to invest in, especially where they're in a growing industry and has products and services that are scalable. There are also management teams who may do a management buyout of a company. And normally private equity will support those as well, where you have a management buyout. And so the private equity would be the one funding the management buyout and then helping that team to transform the company further and to improve its performance going forward.
What type of investors are ideal for private equity?
There's the industry terminology, which is accredited investor, which is those high net worth investors who must have a minimum based on the industry standards and regulatory standards of certain net worth, right? But typically private equity, because of its long-term nature, is also suited for pension funds, endowment funds, and family offices. So in the case where you have a wealthy family looking to grow their wealth and sustain their wealth for the succession of the various family members to enjoy, they also are prime candidates to invest in private equity, because private equity is sustainable. It gives a much higher return in most cases over the years when you annualize it than the traditional investment options that are out there. And it also allows for continuity in terms of wealth creation. And pension funds especially love that sort of investment because of the nature of it, in that it helps to match with their profile in terms of when they need to pay out service benefits to their members. Because of the long-term nature of it, private equity, typically a minimum return of about 20% net of fees is what an investor can expect when they annualize it over a 5 to 10 year period. Because typically private equity invests in operating entities where you grow the bottom line, you grow the revenue stream, you improve efficiency by reducing expenses, expand your product range. So you're making good margins at the end of the day, and the value of that investment continues to grow. So in the typical private equity space, returns north of 20% per annum in US dollars is what is typically expected from an investor.
And what type of companies are ideal for private equity?
An entrepreneur who is now looking for an investor to come in to take some position in the company, one has to ensure that they have all the information on their company, what they're offering, what they're doing, also information on what is it they're willing to give up. Because most times than ever, you find that entrepreneurs come, but they haven't thought out fully what it means inviting someone else into your company to take a stake in it, and what that really means for them as the founder or for the company.
And what are some tips for investors and companies looking to go the private equity route? Delta Capital Partners tells us more.
Tip number one for investing in anything, but especially in private equity, is something called capital preservation. Do not invest more than you can afford to lose. There is risk involved with investing in private companies, often referred to as illiquid markets, where it's not very easy for you to get your money out because it is perhaps tied up in a fund maybe for 3, 5, 7 years, or it is just in a company as risk capital and you have to wait for that business to make a return, pay a dividend, or exit for you to get your money back. So capital preservation is key. Tip number two is you're essentially investing in people. All businesses are run by people. Even the most high-tech businesses, they need a person who is even the head of IT to tell a computer what it is supposed to do. So you have to understand the people that are behind the business that you're investing in. You also have to look at the markets. So I, without apology, I'm not a banker. I don't consider myself a banker, even though people might refer to me now as an investment banker. I look at things first, I was going to say only, but at least first, from the consumer standpoint or the customer standpoint. The only way business grow and the only way commerce takes place is when you have an entity or a person at the other end of a transaction willing to take hard-earned money and pay for a good or service. Understand what you're getting yourself into, right? Know the firm that is investing in you. Different firms have different motivations. Some of them are just very keen on making a return. They could care less about you or about your business. They only want to put the money in, get it back, plus a return. Other companies might genuinely be interested in growing your business and supporting you, and may be willing to take more of a long-term view. So just like how an investor or a firm like ours would diligence the hell out of a business before we place capital, you as a business that's taking capital from a PE firm or any investor need to diligence the hell out of that investor to know what their motivations are. You also then need to think through what's the use of funds. Are you getting an investor to come on board because you want to upgrade your boat or buy a boat and you want to get a new car? Are you getting an investor to come on board because you need to expand your distribution? Are you getting an investor to come on board because you need new minds that can help you take it to the next direction? So you have to have a very clear use of funds in terms of what's the purpose of taking the investment in. And then once you finalize your diligence on the investor, know exactly what your use of funds are and how much funds you need, then you have to ensure that you can be good stewards of those funds, because it's not your money. You're taking somebody else's money who has entrusted you with that money. You're going to put that money to work with the notion of returning that principal to somebody plus giving them a benefit at the end of the day. So it's not enough to just say, yeah man, we raised $1 million US. Okay, great. How are you going to pay it back? Because until you've paid it back, you really haven't done a good job.
So some don'ts for companies who are seeking private equity to come and invest in them. One, I would say for a lot of founders and entrepreneurs, take your emotional response out of the arrangements and the discussions. Don't go with a perceived value of your business unless you've tested what that value is based on the performance of the business. Don't assume that the private equity investor is just coming as a financial sponsor. Right? And most entrepreneurs make that mistake. Don't go taking more money than you need, because private equity expect returns. And at the end of the day, if that cash is not performing and doing what it is, then you may run into problems with the private equity firm in how they address performance and the business. And don't underestimate the importance of proper governance and financial management when you're inviting private equity firms to invest. Those are some key tenets that you must have as an entrepreneur and business owner when you're inviting private equity firms to invest in your company, because those are the top of their list in terms of governance, because poor governance can be very, very costly. First and foremost, it's about the people. Delta Capital team has some of the brightest and best in the business in terms of experience and competences, knowledge, network. And we have a great executive chairman who is a leader in many, many respects. Delta also, because of its network, has deals that covers a lot of the landscape in terms of diversity, the quality of the deals, right? The future outlook of the deals and the industries in which a lot of the entities we're looking to invest are participating and playing in, and the relevance to society in terms of continuity and the services and products that people will need and use for the future. And Delta is pan-Caribbean. So we're looking to create value in the Caribbean. Even if we're doing international investments, we're bringing that value and that knowledge base back here into the Caribbean. We're looking to create employment. We're looking to create sustainability and have impact investments as well, because some of our deals have significant impact investments in the local economies that we're looking to operate, whether it's environmentally or socially as well. And Delta, as the name suggests, is the best. It's balance, and it's about value and creating sustainable value.
And that's it for Banking with Us this week. Be sure to look into investing and how you can get started today. I've been your host, Amita Prasad-Webb, and thank you for tuning in. Until next time. Banking with Us was brought to you by Flight Connections.